Good afternoon, everybody. Welcome to Market Mavericks. Welcome, guys. Good to see you after a week hiatus. How you guys doing?
Great.
Good,
Hello.
good. Well, we have a lot to cover. I mean, we were talking about it a little bit pre-market. You got the Jerome Powell speech tomorrow, 10 a.m. Eastern time from Jackson Hole. We got Fed minutes yesterday. I kind of wanted to bounce a few things off you guys in that respect. But where do you guys want to start? I mean, what do you guys think is the big gorilla in the room, if you will?
That's the Fed. It's right
Fed.
now the Fed and how the stock market responds. Some of us have been, it's the most anticipated rate cut I remember in my only 60 years of age ever. Never seen it. So, and Scott, we've been making so much fun of it. I think the proper word the market's enthusiasm for this rate cut means I think it's more going to be like, oh, finally it's there. Yeah. Thanks.
So, do you think it's going to be a sell the news event then? I mean,
oh yeah, absolutely. It's already starting. I think it's almost. Oh yeah. I mean, well, we can tip over to a few charts, Scott, and we've all pointed this out forever. Is once the Fed starts easing, you're probably better off being in gold than the S&P 500. That's just a fact of history, and it's always worked that way, unless it's just one of those one and dones. And much better off being in gold and copper, gold and crude oil. It's just the kind of things I'll be publishing on soon. It's just a question of, is it going to be different this time? The big difference is the stock market's most expensive ever at the start of an easing cycle versus the market cap to GDP, even versus its 100-week moving average. Recently, almost 25% above that. Fed hardly ever eases in that environment. It's very rare. So it's going to be a fun one. I think for the tactically oriented, this is a tremendous world kicking in of trading.
So one of the things I thought that, and this struck me yesterday, right, is so I've been looking at these charts of gasoline and oil, and I'm looking at that compared to the S&P 500, right? So here, let me show my chart here, guys, and I'll get your feedback on this. So if we go to the S&P 500, we know that from the August low, we've had this big rally up, nonstop rally, incredible rally. And it was on the back that, going into this drop, it was, oh my goodness, we're going to have a recession. It was, this is horrible. Things are, basically the world was falling apart. Nikkei was collapsing. We all know that. And then all of a sudden things got better. We saw for once the markets actually moved on jobless claims, which is super unusual, but they were a little bit better. People were like, okay, wait a minute, we're not going into recession. And then before you know it, it's back to soft landing, no landing at all. So that's what the stock market was telling us, right? But then if you flip over to a chart like oil initially, here's where the stock market bottomed, right, on August 5th. And oil did rally, but then it started to reverse and have a big move to the downside. And if we go to gasoline, and I've always argued that gasoline is an even bigger indicator of financial health or economic health. Gasoline, here's your August low. It's actually taken out those lows. So lo and behold, yesterday, we get the Federal Reserve minutes. And the one thing that was surprising to most people, including myself, was that we found out that many members of the Fed had wanted to cut in July. And to me, I'm like, wait a minute. So what does the Fed know? And why are they wanting to cut so quickly and even last meeting? And what is oil and gasoline now makes sense why it's selling off, but the stock market is not responding to it. So I'd like to kick it to you. I mean, Scott, do you have, what are your thoughts, man? I mean, is the stock market in a world of its own right now and kind of ignoring this?
Yeah, I still don't think we've reached any point where bad news is bad news and good news is good news. And I think that it's a lot of misdirection and that the market is trading, as Mike said, specifically on expectations for the Fed. And we've been joking for well over a year, Mike, certainly on Macro Monday, about predictive markets getting this wrong consistently, right? That in the end of 2023, if you went back to March 2023, we were supposed to have 4 cuts by December 2023. True. And it was 80, 90% for January and February once that didn't happen. And here we are. I think we agree now that there will be a cut in September, done and dusted, as Mike said before the show. But now you start talking about, will there be 6 cuts by March? Will there be 8 cuts by July? And it's sort of the same thing. No matter what everyone's given, they have this massive expectation for more. Listen, I think there's an argument for the Fed not to cut. I think they will now because there's pressure. But I wouldn't be surprised. This isn't my base case, but I wouldn't be surprised if they cut 25 and then do nothing for a while. Give the cut and hang out.
But do you think, all right, so the markets are saying,
because the market now, I think, is saying 6, 8 cuts, 10
Yeah.
cuts. You know what I mean? Because they see finally this one cut. That's the answer
So
to the question.
are investors missing the point here that if the Fed has to cut 6 or 8 times, then we're in a lot of deep shit here? I mean, like,
Yeah.
Yes.
that's the kicker, which I think is interesting about the stock market going back almost to all-time highs, is that if the Fed is going to cut that much, things are really not going well.
It's the word I love learning from crypto people. It's hopium. And what you're seeing is something that's, I find, a tremendous example of human nature. And there is so much profits and wealth that's been created since the end of 2007. I can give you the facts right now. Total market cap to GDP is almost $60 trillion. Right at the end of 2007, before the great financial crisis, it was just below $20 trillion. So almost 70% of total market cap wealth created in the entire stock market has been created since 2007, the biggest money pump period in history. And I want to tilt over just a few little charts and show you kind of my key theme that's happening. I'm calling for basically the correction of a lifetime. I've been early, and that's my theme is crocodile jaws that are set to bite. So I just show you Fed funds are ready to start tilting downward. We know that. And the number one most significant spread in all markets, I think, is gold divided by S&P 500 return. Here's the total return. It's just locked in a narrow range. And every time the Fed starts cutting, gold goes up versus the S&P 500. Fed starts cutting, gold goes up versus S&P 500. Same here. It's so ready to just go up. It's just a question of what takes it. And this is one of the key things I like to point out about gold. I have to point to gold because it's beating the rock's beating stocks for 3 years now, and exactly since the Fed started hiking. Here's what key and started hiking in 2022. Here's one thing that gold loves. This is a 200-day moving average as of the U.S. 10-year yield. It's just starting to roll over. It loves when yields are going lower, just heading lower, just getting started. That's still above 4, and the 10-year notes below 4, and volatility picking up. This is a 200-day moving average of VIX, just starting heading higher. That's bad for risk assets. It's just starting to make the turn. And here's the key thing that's leading it. Bitcoin should lead everything. So here's a similar chart with 100-day moving averages. We have Bitcoin, gold, and the S&P 500 all on the same scale. See this? They were just locked in the same range. Now Bitcoin started to roll over, fastest horse in the race. It led everything up. It's going back down. Volatility is just starting to make a bottom there. That's the VIX. This was a signal that made me a lot of money in 2008. I was early in 2007. Here's a key thing that I want to point out. It's why I stick over to Bitcoin as a leading indicator. Here I have the Bitcoin, just take Bitcoin divided by its 100-week moving average. Now it moves so much, I put that one on log and overlay with the S&P 500 versus the 100-week moving average. Bitcoin always peaks and the S&P 500 goes down. Bitcoin peaks, S&P 500 goes down. Bitcoin's peaked and it's heading lower. S&P 500 still stretched. That crocodile jaw is going to narrow. It's one of those lessons I learned in grains is thou shalt not hold corn in your bins after Memorial Day. And that's one of those lessons. Thou shalt not be long risk assets when the S&P 500 is more than 25% above its 100-week moving average. So I just want to, I'll tilt over this and then I'll pause because this is part of the reason I've been really bullish bonds is this is where I started in the business. I started in this trading business. This is the bond future. And so it's in my blood. And I started in 1988. This is just the bond future, US one, US Treasury bond future overlaid with gold. It hardly ever goes down this much with gold going up. I don't say gold's going to go down. To me, this is the next big potential trade. When US Treasury bonds take off and just catch up to the yield on Chinese government bonds, which are almost 200 basis points below US bond yields.
So just in terms of this, are you expecting a big sell-off in the market by year end, or do you think it's going to be a slow drip down now? I mean, what is the kind of the outlook here that you guys have over there?
Well, I have no clue. This is just me. I have no clue how it's going to happen, but I will point out it's the most expensive stock market on a market cap to GDP basis since the 1920s and 30s. Okay, it's most expensive versus the Bloomberg Commodity Index. You have to go back right here. I have S&P 500 versus Bloomberg Commodity Index. You go back 25 years. And when you have an inverted curve that disinverts, you don't want to belong in stock market versus S&P 500 versus commodities. It's just usually how it works. It's the most expensive versus housing versus the rest of the world. And maybe it'll stay that way. That'll be wonderful. Sometimes it just takes a trigger. And that is what happened in the 20s, what happened in 2000, and what happened in 2008. It just gets too expensive and goes back down. And hopefully it won't do that. But when gold keeps beating the stock market, I'll stick with gold. And that's another thing why I like to put, I like to use Bitcoin as that leading indicator, but this is just one of those things I see how expensive equities are. And this is just versus commodities and how steep the curve is. And it's already starting to invert, but this is using Fed funds versus the 30-year. So that's not going to show up until they actually cut the Fed funds rate.
Scott, turning to crypto, right? So where is crypto? I mean, we know Bitcoin hasn't done a whole lot in the last 3 weeks or so. It's kind of been staying in a very tight range.
6 months.
Is it, you think it's consolidating to break out, or is it? I mean, what are your thoughts?
6 months. Listen, it's below the 50 MA right here. So I think that's 1, 2, 3, 4, 5, basically 6, 7 attempts at the 50 MA since we bought them. So if you're like a technical trader, I don't think with a death cross, which to me is a laggy indicator, but with a death cross of the 50 and 200 and repeated resistance from the 50, you just can't get excited about any of these pumps, I think, until you're back above that. But I think where Mike and I would maybe disagree is he says, Bitcoin has topped, stock market will follow. I just don't think Bitcoin has topped, right? Because I think that we're in the summer doldrums and we'll at least take a shot back at 74 at some point, in the fall and maybe above. So I guess it remains to be seen. I don't think the stock market falls off a cliff before this election. I just don't, right? And so I think that all indicators aside, I think that it's going to be held up at least through November. Then we'll see what happens. So I don't think we see a steady sell-off because that just means the end of the Democrats, right? So I think they'll pull whatever levers need to be pulled, but it's hard to argue with any of the data that Mike is presenting here. I just think that Bitcoin is in its normal. It made a very, very early new high in March because of the ETFs. And so, kind of think of it in this way. If we were doing the normal 4-year halving cycle, we'd probably be chopping between 35 and 45 right now and be really excited that we weren't at 15. But instead, we got to 74 on the ETFs, and here we are depressed at 60. So I just try to zoom out and look at it in the context of crypto only, and that's how I view it. But listen, I mean, if everything does fall off a cliff, crypto is going to go with it for a while.
Do you think that that Bitcoin is going to be determined by who wins the election? Like, obviously the Republicans seem much more favorable to crypto. Is that a determining factor? Or you don't think it really matters?
I think it's a short-term factor that has caught the zeitgeist, but I don't think it matters because it's never mattered before. And I do politics because we have to on the show, but like my unpopular take is that the world's probably going to be fine no matter what happens because it always has been, right? And so I don't think that the world ends if one party's elected or the world ends if another party's elected, and therefore I don't think markets end if one party's elected or markets end. We've heard the hyperbole at the end of every single presidential term about how if this person gets elected, this will happen. This was supposed to be the death of the stock market. I'm not hyping Biden by any chance. I'm just saying Trump said the stock market's dead if Biden gets elected, and here we are at all-time highs, right? Yeah. So forgive me for being skeptical that what politicians tell us or determine will happen to markets may not.
You're not the first one to be skeptical of what politicians
Listen,
say.
I think crypto should perform better under Republicans or has a better chance of being legislated and regulated more reasonably, but Bitcoin is risen above that at this point. I think maybe the rest of the crypto market is much more susceptible to partisan politics. I think that's true. But Bitcoin, it's got the ETF. It's a pretty much recognized international asset. I think that it is at least safe.
And I think that's a good point too, is that to say that the real test of an asset that has legs, meaning it can be around for decades, if not millennia, is that it can withstand a political party that's not favorable to it, right? I mean, I think that's the true test. And I do agree with you. I think regardless of whoever's in the White House, short-term moves, of course, but longer term, I think it's been adopted at this point as a staple.
Let me put it this way. If Bitcoin is what true Bitcoiners believe it is, they shouldn't give a shit who wins an election. So for those same people who say Bitcoin is an opt-out from the entire system, to be hanging on every breath of politicians to see what's going to happen to their beloved asset.
Good point.
They're suffering cognitive dissonance and need to figure out where their beliefs actually lie.
Yeah, that's a good point. Good point. All right. So tomorrow, I know, Mike, you're kind of like, the Fed, everyone's hanging on the Fed. What could Jerome Powell, first of all, do you think he's going to be as dovish as the market expects, considering the stock market has risen back almost to all-time highs? Or do you think he could be a little disappointing? What are your thoughts on his speech tomorrow?
Nuanced. Yeah, he's one thing I enjoy about him. He's quite the smart lawyer. I'll just show you the chart of what's expected in the market. Expected to go 25, a little bit more, and then just keep cutting. So by the end of this year, be a little bit less than 100 basis points. So that means they only have 3 meetings. They'd have to cut at every meeting. But there's only one way, I think, for them to really be aggressively cutting, and that's looking at this chart here. Unemployment's at 4.3%. He's at a trajectory now. Our economist Anna Wong says it might actually tick up to 4.5% by the time we get to that September 18th meeting. Now claims have been showing that, but it's clearly on a trajectory where they should be easy. Now, you mentioned earlier they should do that. I think starting at 25 basis is prudent, but the problem is we all know at market cap to stock market cap to GDP, that's all that matters. And in terms of inflation or deflation, right now it's just showing us so much wealth creation and inflation that he has to be careful pricking that bubble. But that's the like you mentioned earlier, the only way I think they're going to cut a lot is if risk assets go down, spreads widen, and tells them to. But right now, this chart just shows, I think, I love going back, this one goes, I go back to 1947, I'm overlaying, this is just unemployment rate, I'm overlaying this with the gold spot divided by S&P 500. It's just really cheap when and an unemployment ratio going up. This is just, McGlone versus Mr. Facts. If unemployment is going to go to 6, then it's a good chance that that gold S&P 5 ratio might go to 1-to-1. That's what's happened since 1947.
Yeah. So in terms of gold, right? First of all, Scott, are you a believer in gold, that it is a good asset to hold at this point?
Yeah, I think gold's going over 3,000. Whenever we get that recession, and Mike has pointed to it, the reasons tremendously well. And I thought that actually, I've been saying that for quite a long time. I mean, I think that gold was like suppressed. It's been down, and eventually a recession comes. I just don't know, what I've struggled with is the timing. We know there's going to be cycles. Like, anyone who's pretending there will never be a recession, it's impossible, right? So it will eventually come. I just don't think it's coming before the election, right? I mean, I constantly say, listen, if the Fed really starts cutting, we have all the data we need on what has happened historically when that happens. Stock market goes down a lot and gold goes up.
Yeah. So do you remember the 2008 election? Remember that one well. Yeah, we still had it. Market just did what it was going to do. And that's one thing we have to be careful of. I've always enjoyed in markets is when people grab a narrative, they pick on it, everybody grabs on it to make them feel they're hopium they love. And I want to show you one chart that really helped me make a lot of money in 2008. And this is when I heard, this is just the FHSA U.S. Housing Price Index. And it's a normal channel. I go back to like 75. This is what it did in 2006. I remember even Chairman Greenspan missed it. I remember this is one of my best signals. I said, once it did this, it goes above the channel. The narrative back then was the U.S. housing market on an annual basis, overall housing's never gone down on a 1-year basis. And then they started to go down after they did this. Now here we are. It's just, I'm trying not to be McGlone. I'm trying to be McFacts. If you're overweight risk assets, I say, good luck. You overweight the wealthy, the highest levels ever. And they just revert. They just take it. Sometimes it just takes some kind of catalyst. I don't know what it's going to be, but it'll start happening. And it's already started happening with the Fed starting to look towards cutting rates, and unemployment's going up. It's friend's your friend, and it's not friendly for risk assets. Actually, it has been, but at some point you're supposed to say, yeah, thanks. I probably shouldn't be overweighting here.
So one thing I was going to mention too, and congratulations to you both on this. You guys have both been bullish on TLT. TLT continues to move up. We're trading around 98. But one of the things I'm kind of curious about is do you guys believe, if we look at the 10-year yield chart, do you guys believe that we are headed back to levels that we saw back during COVID, like down here? Or is there a base point where you're going to be like, hey, listen, rates are back to 3% on the 10-year. I got to cash out of TLT. Like, what are your thoughts on that for both of you?
It's a great question. I want Mike's thoughts on that. It's a really great question because I don't know.
So I love the narrative, and that was, this has been almost a 40-year trend. This is what got me out of the trading pitch to the New York trading desk, just calling that bond market correctly. All the New Yorkers kept pushing back on me when I kept saying T-bonds are going up, and prices just kept going up, and then finally they brought me over to trade them. in the T-bond desk. And I think I love the narratives, how it's people, there's the consensus completely gave up on that big bond rally about 2 years ago. The most beat up asset in history, most unless a 4-year basis, is US Treasury bonds. I think they're just going to normally mean revert and head towards the signals we're getting right now from the second largest economy is that T-bond yield is about 2.25%. The US right now is 4.13. I think it's going there. The whole world's going there. The trends I'm seeing in commodities, with gold going up and all commodities going down, is clearly globally recessionary. And here I show you, this is the 200-day moving average of that 10-year note yield just starting to roll over. Volatility just recovering from the lowest level in 6 years. Go with that. And where does it go? I don't know, but I think there's a good chance it's going to just resume that downward trajectory. We get a normal recession, and it can be one of the most deflationary ones we've ever had. And it's not profound to say that if you just study the measures of history and deflation. Deflation always comes from when risk assets get too high. I just showed you that in housing. We show you that in the stock market. And they just go back down a little bit. So it's not a big deal, but it's when they go down a lot is a problem.
So, I mean, one of the concerns I have is that, you know, the Fed's going to come out and start lowering rates aggressively. Their balance sheet's going to expand again. The government's going to keep spending. And before you know it, we're going to see another major spike like in the 70s where we had inflation shooting right back up. But what you're saying is that's not going to happen. We're going to see deflation, and that won't happen, or will it?
Can't they both happen, Mike? Can't they both happen, just depending on timing?
Yes, there's so much. Yeah, there's so much time to get to that 10th bridge. The first bridge starts with the easing and the normal correction of risk assets going down. Why did I'll show you it on this chart. I wanted to show you this one. Here is where Nixon knocked us off the gold standard. This was 1971 August. Unemployment had already gone from about 3% to over 6%. And that's when you got to have reasons to do those events first. You have to have a reason to really balloon the deficit. Now, that's the problem. The fact that everything's rolling over, unemployment's going up, and we are ballooning the deficit shows you why gold's going up and it's going to continue going up. But you got to get through that first iteration. It might take at least the first a year. But what you're talking about typically takes a long time. And it's not, let's put it this way. It hasn't happened in Japan. It hasn't happened in China. China's turning Japan, and I think we're just going that way.
Gotcha. Interesting. So then, just looking at assets as a whole, are there any investments to be made aside from, let's say, gold? I mean, even Bitcoin, it potentially could go down if the stock market continues to come down here. Obviously, longer term, I think we all are believers in Bitcoin. But what about real estate? I mean, is real estate a no touch even as prices come down here? You think they'll be much? Are we
talking commercial or are you asking would I buy a house right now?
That's an interesting question, right? Because commercials in huge dire straits right now. There might be deals there. I don't know per se, but
I would not buy a house right now. I can tell you that.
Well,
but I live in Florida. I think things are inflated. No.
Here's where you're buying a house, the most expensive ever, and certainly versus income, we get all that. And it was, to me, it's worse than it was 2006. Some of us, again, had a pretty good period, and I know a good cousin of mine who started speculating in homes around here. But it's the point is, when you get this expensive in all risk assets, you just want to be in assets that are safe and risk off. So first of all, we have Treasury still yielding 5%. We still have a 4 handle on the long bond versus all the coupons now are below 4%, particularly twos are right at 4%. It's probably going to go to 3 and potentially 2 in a normal reversion. It's just a simple thing. Sometimes in life, it's hardest thing for people who've made a lot of money and who are on the sell side and only know one way is to lay off underweight risk assets and overweight risk off assets. Gold and treasury bonds are the top ones. They're simple. Bitcoin is 3 times the volatility of S&P 500. Good luck. Maybe when things go down, it'll do better, but I doubt that. Housing, everything. It's just one of those things. I look at this is, like I said, we're in 1928, 29 on the way up. This is exactly what that stock market and GDP did, and then it just went down. And it just kept going down. But obviously it's different. It's just the key thing, as I like to point out, is there are few better indicators than this little thing called Bitcoin, and it's starting to roll over.
All right. So for both of you guys, I got a question. We've gone a lot of doom here, a lot of doom. Can you guys give me something positive?
Gold.
Yeah, I mean, this music could keep playing for a very long time.
It
Yeah,
can.
but
It's a good
Mike,
point.
gold.
It can
Let's
do
be
that, but
fair. Gold is a play on doom, kind of. So like, I guess my point is there any silver lining here to anything that's going on, or is it? I mean, is it really as bad as
But
it
gold
looks?
could go up. Gold could continue to go up, by the way, if the music keeps playing. I mean, central banks are
Oh,
buying it
sure.
all over the world. I don't think gold has to
Yeah,
crash because stocks go
That's
up.
true.
So there's a world where
that's
things just kind of
yeah.
float up.
Well, that's part of the win-win.
Back
But
up, boom.
it's put it this way: from a guy, an ex-trader, ex-hedge fund trader, an ex-person who's on the phones. This is an ideal environment for those more tactically oriented, i.e., most of the people listening to this program, and certainly you too, and even me. I just don't trade. I just long-term. I'm way underweight risk assets and overweight just treasuries. I mean, it's easy to say that. You can take a lot of risk in a long bond when yields go down. I mean, that's what blew up long-term capital. They just were on the wrong side of that trade. But this is a tremendous environment. But the depreciation we got in home prices that everybody, 65% in this country who own homes that we've gotten in the biggest money pump in history is made people feel very wealthy. It's kept inflation high. And it's keeping interest rates high. That will revert. It always has. And when it does, just be safe. Don't be one of the ones heading stops and overweight leverage. And that's one thing that we all know is going to happen. There's one thing that happened the last time when we had this housing crisis. Things like Airbnb, VRBO didn't really exist. Now we have a lot of people involved in those trades and expecting income from that. And this is where I'm thinking this is, it's just normal reversion. And there's ways to really do well. And that's why I say just this is not a time to be over leveraged long risk assets.
So one of the things that struck me yesterday is that I was reading an article about what some of the Fed minutes, and they talk about their big concerns for the financial system, and it was something I didn't honestly know is that a lot of funds are leveraging themselves in the bond market, and the Fed actually said this is a huge potential risk to the financial system. And again, Mike, you might know more about this than me, but essentially, it seems like they were shorting futures, going long the bonds, and then borrowing money from the reverse repo market to actually then leverage themselves out even more.
Nothing.
Can you explain that or
nothing? I used to do it. I used to have hair. It was my life. I mean, so when you run a primary dealer and a customer, ask you to offer 10-year notes. And you sell them to them, you just repo those out. Everything is repo. The U.S. Treasury market is the most leveraged market on the planet. Long-term capital remind us of that. They were doing things that are 100-to-1 leverage. So what you're seeing and hearing have been wrong for a while. All these indicators showing that there's massive excess shorts in the futures because they're trading basis. Basis means they're doing things in cash. But there's a lot of room for that to blow up in the leverage. The yen carry trade showed a little bit of that, but I'm not so worried about that as spreads widening, the yen carry trade, yields going up fast and wiping out the yen carry trade. But that's the key thing to remember about treasuries. It's the most leveraged market on the planet, partly because it's zero risk, but there's so much that you can do with derivatives. My life, like I showed you in this bond chart. Where was that bond chart? Right here. No, I got it right here. Yeah, I forget this one bond. Is these? I can't find it. It's just the. I'm not so worried about it. It's the macro that matters. Everything's fine as long as the tide stays elevated. It's when the tide goes down that you're more worried about stuff. That stuff will be reciprocal to the tide going down. And then there's credit spreads and things.
Yeah. All right. So lastly, I just want to go back to crypto, Scott, and talk a little bit about the altcoins. So we've seen a couple altcoins doing really, really well. I was noticing Tron recently going to new recent multi-year highs, to be honest, going back to 2021. Is this just, again, a flash in the pants kind of thing where you expect these things to come back in, or are people actually, is big money starting to look at some of these altcoins and say there's actually some value here, let's get in?
Yeah, I think interestingly, the last few days we saw some of the undervalued dinosaurs start to move. This is TRX, to your point. I mean,
I even saw Cardano starting to uptick.
Yeah, less than 20% off the all-time high. Maverick, which has been very quiet. I just happen to have these up. FTM, a lot of these sort of old narrative ones where there actually are relatively large communities that have just sort of been waiting for, I guess, the meme craze to die or any hint that the cycle might start up again. But there's a lot of people that still hold or want these coins to go up. In the case of TRX, there's very fundamental reasons that nobody pays attention to because it's just a hated rally. but Tron, the 56%, I think now, of USDT and USDT transactions are on Tron.
Wow.
Literally, the entire world is using Tether on Tron because it's cheaper and faster, and that requires owning TRX to do, right? And so, like, there's a reason that this has been basically rallying nonstop since the lows in 2020. It's just people don't like it, so they don't pay attention to it. But now you also have, God, I hate to even go in this on a macro show, but obviously the meme coins are moving to TRX as of this week, to Tron. So that's been Sun Pump, the competitor to Pump Fun, and memes are going crazy on Tron, which of course means you have to buy TRX to participate in that. And that's what's happening. But there are reasons. This is actually probably the most used chain on a day-to-day basis for small transactions around the world.
Interesting. I didn't know that. Very cool. All right, guys. Wow. Good information, great discussion, and great to have you guys back here on a Thursday afternoon. So let's do it again next Thursday, folks. Thank you all for tuning in. We appreciate it. Many, many of you guys. I see huge numbers on the watch list. So follow these gentlemen below. There's their socials at the bottom, and we'll see you next week. Take care, guys.
Bye, guys.